Today, we're going to talk about where you need to save for retirement and primarily be discussing multiple types of retirement accounts. When we say retirement accounts, I really want to preface we're going to be kind of breaking them into two categories. The first category is going to be specific retirement accounts. So, accounts that are designed specifically for retirement, like your 401ks, your traditional IRAs, your simple IRAs, your solo 401ks. These are all accounts that they have certain advantages and certain restrictions and limitations applied to them because they are designed and constructed specifically with retirement in mind. Now, there's also other types of accounts called investment accounts, or you might hear them called brokerage accounts. These are accounts that aren't designed specifically for retirement, but they are places where you can invest your assets. So I often describe these as similar to like a savings account or a checking account you might have at a bank, but they just allow you to invest assets. So looking at those, these might be a little bit more unfamiliar to some people. You have your individual brokerage, your joint brokerage account. Those are going to be two different types of accounts that, like, if you're a couple and you're investing together, or if you're just an individual, you have your custodial accounts and your UGMA accounts. These are going to be accounts typically designed to cater to minors, like minor children, like a custodial account and UPMA and UGMA are similar styles of custodial accounts, but it's where the account is for the minor but owned by a parent until that minor becomes the age of majority or an adult, which varies based on state. And then you have trust accounts. These are primarily used for estate planning purposes or very specific designations that someone might have for certain assets. Like they want an account to be split a very specific way across multiple people across a long period of time. A trust account might be created to be used in that situation. Now, when it comes to retirement accounts, there's really two subcategories under the retirement accounts category. There's employer related accounts and there's individual related accounts. So, employer related accounts have to be connected to some sort of employer. You can be self employed, you can work W 2, get like a W 2 paycheck from like a Microsoft or an Apple or Tyson, and they have a 401k. You can be a teacher and they have a 403b, but it's connected to an employer. So you have to have kind of wages coming from that. If you're self-employed, you can use a solo 401k. If it's just you, like a lot of times realtors will end up using solo 401ks, or they might use a SEP IRA, which is another variation if it's just kind of you or you and your spouse as a small company or a small business. As soon as you start to get on employees, then the simple IRA comes into play. But again, that's typically for small business owners, whereas your 401k, 403b, you typically see with larger organizations. The simple IRA, the SEP IRA, and the solo 401k are all typically like your small business owners or your independent contractors. But they do have to be connected to an employer. Now, when an individual basis, you still have retirement accounts, but you pretty much only have traditional IRA accounts and Roth IRA accounts. Now, there's slightly different tax treatment here, but these do not have to be connected to an employer. They can be done just with an individual. Now, you do need earned income to contribute to both of these, but you do not have to have them connected specifically to an employer. Now, when we're talking about those retirement accounts, certain characteristics they have, tax advantages. So there's really two types of tax advantages that retirement accounts have. There's pre-tax retirement accounts and there's Roth or post-tax retirement accounts. So when you talk about a pre-tax retirement account, one thing it does is it lowers your current year's tax burden. So say hypothetically, you were making $100,000, you put $10,000 into a 401k. Well, now this year you made 100, but you put 10,000 into a pre-tax 401k, which means you're only going to pay taxes on $90,000 that you earned that year because 10 of it went to that pre-tax 401k. And in turn, that money grows tax deferred, but it is taxable when you take it out of your account in retirement. Now, what a lot of people kind of have to balance is, okay, does it make more sense to do something like this that's pre-tax or Roth right now? Well, Roth, it doesn't give you any tax benefits today, but it is tax free in retirement. So say hypothetically, again, you make $100,000. let's say you put $5,000 into a Roth IRA, well, you're still paying taxes on the full 100,000, but that 5,000 grows tax free. So when you pull it out in retirement, it's not taxable. Now, there is a lot of things that go into the does pre tax make sense or does Roth make sense? And I'm not going to jump into all of it today. We'll have more videos and we have some videos on that topic, but just know those are the two general types of tax advantages you get with retirement accounts. Now, there's also contribution limits. So, contribution limits are there on retirement accounts because essentially, when you have those kind of tax advantages, there is a limit with how much you can contribute. Those limits change year to year. So, there's going to be limits that say, all right, well, for Roth IRAs and IRAs, it's timestamp this in 2022. If you're under 50, you can put $6,000 into both of those accounts, but it's capped at $6,000. You can't just endlessly put money into these retirement accounts like you can a brokerage or a taxable account, if you will. There's also change based on the type of account. So changes from year to year. So each year you're going to get an adjustment, usually like a cost of living based on how much inflation has moved, is how much you can put in each of these accounts. Also, each one of these accounts is going to have a different limit based on what they are. So 401ks have a certain limit. IRAs have a certain limit. SEP IRAs have a certain limit. Simple IRAs have a certain limit. And all of them are different. And all of them have a variety of different rules that go along with those contribution limits. So you can't just blanketly say, oh, I have $6,000 I can put in. It's going to go in any of these. They all have slightly different rules with what you can put in and what you are allowed to put in based on a variety of different things: your income, how much you've earned, how much your spouse has earned, what you have available to you through other means of savings. There's always going to be something you'll need to check on those. And then, two, they may be limited due to your income. So, certain accounts, specifically the traditional IRA and the Roth IRA, if you make too much, you are no longer eligible to contribute to those if you have access to an employer sponsored for or a retirement plan. And that gets into a whole different subject, but depending on your income, it might restrict the types of accounts you were allowed to contribute to. So they have these tax advantages that are great, but there's also some fairly limiting restrictions on when you can contribute and how much you can contribute. Other restrictions are on how you can withdraw those funds. So, with retirement accounts, again, the idea is they're geared towards retirement. So, what's been put in place is they don't want you to put something into these accounts and then pull it out 5 years later in your late 30s or in your 40s. They want it specifically to be designed for retirement. And in turn, those tax advantages make the most sense the longer you have to compound on those retirement assets. So, what the restriction is you cannot pull without being penalized from those retirement assets, those retirement accounts, until you are 59 and a half years of age. Now, that is going to be subject to change. They will probably move that at some point in time, but right now, 59 and a half is the target. Now, there's some rules regarding 401ks that allow you to pull at 55. There's some rules regarding Roth IRAs that allow you to pull after 5 years. But in general, if it's a retirement account, 59 and a half is the restriction. You have to wait till to be able to withdraw from that account without facing a penalty. And right now, that penalty is 10%. Now, as far as investment accounts, these do not have nearly as many restrictions, but they also don't have nearly as many advantages as you would typically see in retirement accounts. So there's no limit to the amount you can contribute in an investment account, mainly because there's not a tax advantage. So the IRS does not care if you put $100,000 or $200,000 or $100 million into a brokerage account because you're not getting a tax advantage down the road. There's also no restrictions on when you can withdraw from this account. So this makes an account, this type of account or these types of accounts, really good types of accounts to save for kind of medium term goals. So something that's not necessarily a retirement time frame away, but something that's maybe 10, 15 years away that you want to do, possibly a rental property purchase, possibly like a boat or a large asset purchase. Being able to save in an investment account, get a little bit more return than a savings account. It's more risk, yes, but a little bit more potential return. This would be a good avenue for that because you can pull the money whenever you want. There's no tax advantages. Now, there's no tax advantages to these accounts. You get capital gain treatment. And when I say capital gain treatment, it depends on how long the money has been in the account and how long you've held a certain position for. So, say you put money in the account and you buy stock A and you hold it for longer than a year. Well, if you hold it for longer than a year and you sell it, it's long term capital gains treatment. But if you hold it for less than a year, it's short term capital gains treatment. As of right now, short term capital gains are taxed at ordinary income rates and long-term capital gains are taxed at more favorable rates. So the current brackets for those are 0, 15%, and 20, with most people fitting somewhere in that 15% range. Now, in other cases with custodial accounts and trust accounts, there are a little bit more, I would say, complex tax implications when you're dealing with minors and having to tax as minors, or trust accounts and certain amounts of income being left in the trust. Both of these accounts, I would recommend speaking with a tax advisor for if you have them and you are dealing with certain tax ramifications from those. A trust account has to be established by an attorney with a trust document accompanying it, and it's going to be something that's really designed for your more complex issues. A custodial account, again, if you have a child that earns income or you have a child that's accrued a large balance, that can also have pretty tricky tax implications as well. But those are two things just to be aware of for those two specific types of accounts. And when we talk about custodial accounts, that also applies to UGMA and UTMA accounts. Now, a couple questions. One being, when to use which account? So I always recommend, if you're planning for retirement or you're starting to save, starting to invest, you want to look to see where's the easiest thing to start out at. And a lot of times for most people, it's your 401k or your 403b. A lot of times there's going to be a match that the employer is going to do within that 401k. So you get a little bit of a free bump in contribution. It's going to come directly out of your paycheck, which makes it pretty easy. And a lot of the times there's pretty simple, straightforward investment options within those. Now, if you're planning again for a short-term goal, something that you know isn't retirement related, well, that's where the taxable account comes in. So those brokerage accounts, those individual accounts would come into play there. The other thing is that if you've already maxed out your retirement accounts, you've put as much as you can into a 401k, you've maxed out your Roth IRA, then the brokerage account's the next logical option, because really that's all you have left to you to use to still be able to invest in stock market or in bonds or in fixed income, anything like that. So it depends very much on what you're trying to do in your situation, but there's usually a couple easy ones you can do first by the 401k and maybe the taxable account, depending on what your goals are. Now, second question, should I use a retirement account or a taxable account? And we've kind of talked about this a little bit. Again, it's going to depend on what your end goal is. If you're wanting retirement assets, you want to get the tax advantages. They are there for a reason. They're extremely beneficial. So if you're planning for retirement, do what you can in retirement accounts first, because those tax advantages are absolutely phenomenal. If you are planning for a goal that is not retirement related, then use a taxable account. If you have something that is estate planning related, that you can use a trust account for. If you're planning for college and you don't want to use a 529, you can use a custodial account, or you can use a joint brokerage or an individual brokerage. If you're just wanting to buy a boat in 10 years, you can use a brokerage account for that. But it's really going to depend on what that end goal is, because again, the retirement accounts have restrictions on when you can withdraw from them. Now, can and should you use multiple types of these accounts? I would say yes, hands down. You can use multiple types of these accounts, and I would always recommend pairing them to kind of fit your situation best, because In reality, most people's lives are not shooting for just one goal at one time. Retirement's going to be a goal all through your working career, all through your life. You're going to have other short term goals that pop up within that where you'd want to use a taxable account, you'd want to use a custodial account. And there's also going to be times where your income's going to be a little bit higher and you want to avoid taxes today more than you want to avoid taxes in retirement. So you might switch between a Roth retirement account or a pre tax retirement account just depending on where you are from an income standpoint. So it's not a sit it and forget it type thing. There's always going to be situations to try and optimize what you're doing to make sure you're doing the best that fits your long term goals and your short term goals. But those are a couple common questions we get fairly regularly along when to use these accounts, how to use these accounts, can you use them together? But we hope this has been helpful. Again, we'll keep putting videos out on these topics. But I hope you have a great day.